Hello, good morning, everyone. We have a slew of stock counter updates that we'll give today. You can see the stock counter updates on the table here on your the left-hand side from the 2Q first half 21 results that most of the companies reported. And then we'll end with a Singapore weekly. So because there are a lot of updates, so without further ado, we'll start. We'll start off with the Singapore Bank's results for. Yeah, so we provide a summary of the 2Q21 report card. The Singapore banks reported results about 2 weeks ago. All three banks reported results. So in summary, the earnings were stable across the board, the provisions were lower, and the CET1 ratios continue to improve above the regulatory and ideal operating range. So if you look at the table here on your left-hand side, the NIMs, we believe the NIMs likely bottomed in the first and second quarter of this year. Loans growth guidance maintained at high single digit for FY21. So if you look at the table here on your left-hand side, the first row rather, you can see that the NIMs have largely stabilized. You can see for DBS groups, NIMs retreated about 4 basis points. It's the same for UOB, retreating 1 basis points, but OCBC actually showed a improvement in the overall NIMs plus 2 basis points, mainly because of improvements in the loans in the Greater China region. The net interest income, which is you can look at this in the second row, also improved, even though some of the NIMs retreated. For DBS, net interest income declined just 1% on a quarter-on-quarter basis. We're comparing the 2Q21 results with their first quarter 21 results. You can see for OCBC and UOB, their net interest income actually improved on a quarter-on-quarter basis. This is really testament to the strong loans growth seen across the board. So we understand from management that the strong loans growth is across a wide range of industries, which is positive. What it tells you is that the overall economy is improving. Tellingly, net fees and commissions also continue to grow at an average of about 22% across the board, 22% year-on-year basis. And this was driven by increase in wealth management fees and loan-related fees. On a quarter-on-quarter basis, though, this retreated for all three banks. You can see that for all three banks, we did see a single-digit decline for all of the three banks. The reason why it declined on a quarter-on-quarter basis was because of the high base effect from first quarter of 21, because they had a very good trading quarter in the first quarter of 21. So we are not alarmed by the in fact, this is within expectations by the drop in the net fees commissions. But if we look at it from a year-on-year basis, of course, I say like double-digit growth. So really very strong. Credit costs continue to moderate across the board. Full year provision guidance for the banks have been lowered. If you look at the next row here for general provisions, you can see that with the exception of the DBS, with the exception of UOB and OCBC rather, the DBS continue to reverse the general provisions, the significant general provisions that they made in 2021 in anticipation of the crisis. But because I think they can see that they've really made very, very significant provisions, so they're actually reversing out some of their provisions now. Credit costs, when you look at UOB's GPs, you can see that they only made 6 million in GPs also. Really, so but the only negative surprise was OCBC. You can see that GPs actually crept up from the 9 million in first quarter of 21. It actually went up to 101 million. And this increase in general provisions is because of the outlook in Indonesia and Malaysia, because of the significant number of COVID-19 cases there. So they are making higher provisions. But NPL ratios are generally stable. It remains unchanged across the board. It's 1.5%. The CET1 ratios, because of their stable earnings, CET1 ratios also continue to improve. Is now the range here. If you look at the last row of the table, you can see that the CET1 ratio is now at 14.2% to 17.5%, and this is above their ideal operating range of 12.5% to 13.5%. We believe this will prompt a more active management of capital. When we say active management of capital, what we mean is we think that they could distribute this in terms of a special dividend. But what we also mean is that we think that they could be more aggressive in terms of M&A opportunities, in terms of engaging in M&A. And this is something that we've seen DBS and OCBC also do more actively, especially in the last few quarters. tellingly, the banks are not ruling out any special dividend, but we think that they will likely only declare the special dividend when the macroeconomic outlook improves. So they won't do it now, not when the outlook is still a little bit uncertain. In our last slide on the banks, in terms of the updated banking sector recommendation, we believe our call on the banks is still positive, because we believe that they will continue to see improving ROEs for the rest of 2021. The strong capital ratios also support the special dividend once the economic outlook stabilizes. For DBS Group, that's our top pick. We maintain accumulate with a higher target price of $32 from $31.40 previously. This is because we raised our FY21 earnings by 6.7% as we lower our allowances for the full year. For UOB Group, we maintain accumulate with a higher target price of $29 from $28.70 previously. We raised our FY21 earnings by 7% as we crank up fee income estimates on the back of strong growth in their wealth management business. For OCBC Group, we maintain buy with a lower target price of $14.22 from $14.63 previously. We reduced FY21 earnings by 2.3% as we raise our allowances expectations for FY21 in view of the uncertain economic outlook. So that's all from me for the banks. For next up, we have the Singapore Exchange. For SGX, they were really dragged down by treasury income. So in our next slide, we provide a summary of their overall results. FY21 revenue and earnings came in below our expectations, and 95% and 93% of our FY21 earnings estimates is FY21 because their year end is June. Yeah, so variance came from lower than expected equity and FICC revenue. So the positive for SGX is their new businesses continue to accelerate growth. Their newly acquired businesses, BitFX and Scientific Beta, contributed $27 million to second half 21 revenue, and are expected to remain growth engines for SGX. So you can see, because of the contribution from BitFX and Scientific Beta, if you look at the table here on your left-hand side, you can see BitFX is actually included under FICC. So fixed income, FICC means fixed income, currencies and commodities. You can see on a year-on-year basis, this actually grew by 30%. And then Scientific Beta is categorized under data connectivity and indices, DCI. So if you look under this row here, you can see this actually grew 4% on a year-on-year basis, of course boosted by these two new acquisitions. The underlying business is also resilient. If we exclude treasury income, revenue actually grew 7% on a year-on-year basis, lifted by commodities trading volume, security settlement, and corporate actions revenue. But the negative for us, for SGX, was because of the lower yields, this dragged equity derivatives treasury income. And the lower bonds listing also and quantums also dragged their earnings, which is why it came in below expectation. So in terms of our recommendation on SGX, we lower our earnings for SGX because they are actually now guiding for higher FY22 expenses. So what they say is they're investing for the medium term. They are guiding for FY22 expenses, OPEX, to be about $565 to $575 million. This is an 8.6% increase from their FY21 OPEX at the midpoint. So we take the midpoint, let's say $570 million. So more than 50% of the increase will be for near-term investments. This includes setting up the Forex ECN climate-related initiatives and continued investments in BitFX and Scientific Beta. So this was a bit of a surprise. We raised FY22 OPEX by 29.8% to the midpoint of their guidance. We maintain neutral on SGX with a lower TP of $11.54 from $11.95. Our target price is still pegged to +2 standard deviation of its 5-year mean, or 25 times PE. Financial year 22 earnings have been reduced by 19.4% to incorporate the higher expense guidance of $565 million to $575 million. So that's all from me. I'll now hand over the time to Jie Hui.
Thanks, Terence. Yeah, so next we have our first half results from First Sponsor. Next, please. Okay, so results-wise, if you can look at the table on your right, you can see that the main reason for the 50% increase in revenue is because of their property development revenue that rose 262%. This came from the handover of 600 plus units at their Chengdu Millennium Waterfront project. So hotel revenue also saw an uplift This is given the relaxation of travel and lockdown restrictions. But you can see from the table, the GP is actually down by, the gross profit is actually down by 11.1%. This is due to lower property financing revenue, which has the highest gross profit margins, and this is attributable to the lack of one-off income. In terms of the negatives, First Sponsor has an anchor tenant at one of their hotel properties that went through the legal route to seek partial rent suspension. The judge ruled in First Sponsor's favor, but there is no assurance that the tenant will not pursue further legal actions. So First Sponsor actually has a 3-month banker's guarantee and a clause to terminate contract should the tenant default on their rents. So we believe that they will still continue to pay their lease obligations. Next, please. Okay, now in terms of outlook, the property development segment in the Tongkang market is still hot despite cooling measures. First Sponsor managed to divest equity interest in their Isan 1 REIT portfolio at 100 to 200% of over their book value. The pipeline of property projects yet to be unlocked still remain robust, with about 3.4 billion worth of gross development value that's yet to be unlocked. And this includes their new Human Boyong project that is newly acquired. Construction and pre-sales are expected to commence in 4th quarter of 21 and 3rd quarter of 22 respectively. Now for European hotels, it's expected to pick up as most EU citizens are allowed to enter the countries regardless of their country's infection rates. This is given that most countries are at least 50% vaccinated. Property financing is still growing, especially in the PRC where First Sponsor is doing more property development deals coupled with financing components. So relating to the 330 million default loan that was mentioned in the previous updates, the borrower was paying its principal and interest and default interest, but has failed to make its 4th payment fully on 30th June. So First Sponsor filed a court application to auction the mortgage assets. That's it. We are optimistic about the recovery given that First Sponsor has dealt with default cases before, and we do expect both principal and default interest to be fully collected by next year. Next, please. Yeah, so the last part on valuations, we raised our valuations for development properties, property financing, as well as interest in associates, given the project undertaken during the year. This is offset by the recent stick divestment of Isan 1 REIT portfolio and higher net debt due to increased borrowings. We still maintain our call and target price at accumulate and $1.56. Okay, next, please. So now on PENU's first half. Next. Okay, so the results were good. Ready-mix concrete sales volumes saw a strong recovery coming from a lower base during circuit breaker last year. Prices also went up due to raw material prices. So the revenue from the concrete and cement division went up by 50%. Net profit line was also lifted by the contributions from associates. You can see from your table on your left, on your right. PENU has an associate called Lana Harita that does coal mining, and the company benefited from higher coal prices. So another positive is also that after paring down their debt, PENU currently has a lower gearing. Interest expenses were lower for first half 21. In addition, PENU paid out a 0.5 cent dividend for one half 21. Given that the payout is higher than their dividend policy to distribute 30% of their annual PATMI, we believe that this signals renewed business confidence, especially for the half year going forward. Next. Yeah, so for the negative, trading volume has been impacted due to the absence of coal trading. There continues to be a nationwide manpower shortage in Singapore attributable to lockdowns in neighboring countries. PENU also faced raw material disruptions that hampered its ability to fulfill contracts, as the company will need to search for alternatives. If the lockdowns are extended, we believe that staff costs and contract volumes may be affected in the second half. Now for outlook, construction projects are still ongoing, led by public sector BTOs. BCA's construction demand projection for for full year 21 still remains unchanged. PENU still has the capacity to take on another 10 to 15% increase in RMC demand in Singapore. So overall, we maintain a buy with a higher target price of 44 cents. This is largely due to a raise in margins to reflect better cost efficiencies as well as higher associate contributions. Next, please. Okay, now moving on to IREIT Global's first half. Next. Okay, so the positives are that the income stream remains stable. MPI and DPU is in line with expectations. Portfolio valuations also increased by 3.9% half on half, and this is due to lower discount and cap rates applied. Berlin campus, which is IREIT's largest property, saw a 7% increase in valuation as its major tenant didn't exercise its lease break option. There are no observable negatives for this quarter's update. In terms of outlook, it's likely that we will see improved occupancies for the Spanish portfolio in 3Q21, given the new leases and lease extensions signed. IREIT also divested the car park that is adjacent to their Darmstadt campus at 10.5% above valuation. The rental impact is expected to be less than 3%, and we believe that this move is to gear up for future acquisitions. All in, we are upgrading our call to a buy with a higher target price of 75 cents. We raised FY21 DPU by 0.5% on the back of higher FY21 revenue. This is offset by Darmstadt campus car park disposal. Now, following a narrowing of discount rates, do you mind? Yeah, okay. So, following a narrowing of discount rates by its valuers to reflect the resilience of the European office asset class, we lower our COE assumption from 7.9% to 7.3%. Accordingly, our TP climbs to 75 cents from 68 cents. Yeah, so this is all for IREIT. I'll move on to Prime US REIT. Okay, so next please. Yeah, so for Prime's first half results, the main positive came from their rental reversions. Prime has signed leases at positive rental reversions of 10.5% in second quarter for about 52,000 square feet of leases, which is close to the amount that was signed last quarter. This 10.5% number mainly came from the leases that were signed at 2 buildings where expiring rents are still 11 to 13% below market rents. So moving forward, we are still expecting positive rental reversions, given that portfolio in-place rents are still below market by 6.4%. Now for the negative mainly came from low occupancy and car park income, which is due to lower than expected revenue. This is despite increased contribution from Park Tower, which was acquired in February last year. Portfolio occupancy fell by 1.3%, and transient parking income that used to contribute mid to high single digit to the top line was affected by about 60%. As such, NPI was lower given the higher expenses from the new property. DPU declined 5.4% from a larger unit base. In terms of outlook, we are expecting leasing weakness to persist in third quarter, aided by widespread vaccinations and a return of employees to their office. Physical occupancy increase. Leasing, however, still remains below pre-pandemic levels. The national office vacancies in the US rose 1.5% quarter on quarter. Our take is that even though Prime has been discussing leasing with prospective tenants, actual space commitments usually lag leasing decision by a few months. So this means that committed portfolio occupancy can be expected to bottom out only in fourth quarter this year. Now for our valuation, we factor in additional income from its newly acquired properties, but lower our rental and occupancy assumptions for FY21 to capture the declines in car park income and a softer leasing market. After accounting for a larger unit base, our DPU estimates for FY21 and FY22 has been lowered by 10.5% and 0.7% respectively. All in, our target price is largely unchanged, so we maintain accumulate and a target price of 94 cents US cents. So now lastly, I have Lendlease Global FY21 full year results. So the positive is that DPU met expectations even though NPI missed. The lower NPI is due to lower rental income amid phase 2 heightened alert. DPU met aided by higher forex gains of 5.4 million in second half of 2021. The negative is that portfolio valuation fell for both IREIT's key properties. So both 313 and Sky Complex fell by 2.5% due to higher discount rates. Valuers also projected longer rent-free periods and rent-free periods of 1 to 2 years and lower renewal rates. As a whole, the portfolio dipped 1.2%. This is held up by Greenfield Car Park redevelopment that was newly added into the portfolio for this financial year. In terms of outlook, tenant sales and more visitors may remain muted even as economic and community activities are resumed in a calibrated way. Demand for retail likely to remain soft with continued safe distancing and border closures. So this may weigh on 313's rentals. Sky Complex is still expected to remain resilient given the long WALE of 11 years. On 7 June, on 7 June, LV completed the acquisition of a 13.25 percent stake in GEM. LV is in the midst of acquiring the 3.75 to close to 15% stake for the GEM acquisition. So based on pro forma 1H21 numbers, the acquisition is expected to be yield accretive at 3%. Portfolio AUM will expand by 18%, apart from increased exposure to the suburban retail segment, which has been resilient during the COVID-19 pandemic. 313 will represent no more than 56% of the enlarged portfolio, thereby reducing concentration risk. Furthermore, LV can potentially increase its stake further in GEM to support its near-term growth plans. So in terms of valuations, we lower FY22 revenue and NPI estimates by 6% and 4% respectively. This is to reflect slower rental growth. We assume that LV will complete its acquisition to own 31.8% stake in GEM as a whole and acquire an additional 5% stake by the end of FY22. This is the main reason for the uplift in target price. For now, the recent share price value of 16% has priced in the positives in our view. So all in, we upgrade our TP but downgrade our call from accumulate to neutral. So this is all for LV. I'll pass my time on to Paul for StarHub.
Okay. Thanks, Jerry. So move on to StarHub's results. In terms of the title, just that we just titling this way in the sense that you are earning a 4% dividend yield as you wait for borders to reopen and you will start getting the roaming revenues. Next slide. In terms of the results, what was positive from the results was broadband. You can see the second box highlighted. So broadband did well. I think it jumped 12% year on year, mainly because of the ARPU. There was an increase in ARPU because they removed some discounts. The only troubling part is that they lost almost 6,000 subscribers, which is a record. So there's something to watch. The other positive was they cut operating expenses down 10%, which is a lot. I mean, considering it's about 700 million. And also most of it was due to the pay TV content costs. As you know, because as they are moving away more from fixed content to more variable, otherwise the pay TV will continue to hemorrhage losses. In terms of the other positive was the cybersecurity arm. So cybersecurity, the revenue was up, but I think they also managed to turn around the profit after tax from a loss 3 million to a marginal profit. Profitability is still low because they still continue to invest in a lot of headcount. And you know, cybersecurity, these are all expensive headcount. The negative was mobile. So mobile is still weak. Mobile was down 9%. You can see from the first box. Postpaid ARPU is down. I think they're still feeling some of the effects of the roaming. And also prepaid subscribers was down a huge 20%. And the reason is because of the loss in tourists and foreign pass holders. So in terms of the outlook, we think the performance will still be this way. I mean, it will be like flattish for now until the borders reopen. They maintain all their guidance. That's the outlook. Our view for this stock is just that there is upside to our forecast. So just as a refresh, roaming revenue is about 20% of revenue, and profit could be as high as 30% because it's very high margin. So once the border reopens, you're going to get this big jump in earnings. I mean, not sure when, obviously, but at the same time, you're just being paid 4% dividend yield as you wait for this. The other share price, which we're not factored in, of course. The other factor will be the next catalyst will be the cybersecurity. It's a bit hard to value right now, but I think if there could be some re-rating, I mean, if they do some restructuring, and I don't whether they want to list it or not, or no, or if there's some sustained profitability. So there's a bit of hidden value here because that is not properly factored out in terms of the valuations. So this could be two possible catalysts, but again, the timing is unclear, so that's why we can't factor in any of this yet. Next slide. In terms of venture, it was really just a modest rebound in revenues, disappointingly. Next slide. So for venture, the main highlight for us was revenue. If you look at the box there, you can see the revenue is up 5%. But the issue here is that in first half of last year, when COVID hit, their revenues fell in first half 26%, but you can see right now the rebound was very soft. They dropped 26, but they only rebounded 4.9% or 5%. So you can see that. So let me just go through to the positives first. Positive is still the cash flow. I mean, this company is now, I think they got almost $1 billion roughly of cash compared to 800 plus. So they continue to pile up cash. Dividends was maintained at 25 cents. The negative, like you mentioned, is that it is still weak. I think the rebound, they didn't bounce back as much as we kind of expected because it was only up. Still, if you compare to pre-pandemic, which is first half 19, just to get roughly what's happening compared to pandemic, the revenue is still down 22%. In terms of the results was basically in line with our estimates. In terms of outlook, they guided that our orders are still strong, but they are facing two headwinds. Firstly, is Malaysian operations is Malaysia now you can only use 60% of your workforce. I think now it's improved a bit to 80%, so they are being hindered by that. The next one is, of course, the component shortages. So that is a big disruption, not only for them, but I think all contract manufacturers. And we still maintain neutral. I think we kept our numbers. But we think more likely recovery scenario will be in second half 2022, because what you need is the life science and genomics products, which is all just been launched. So you need time to scale that up. And with all these shortages, we think venture's probably going to see the rebound only in earnest in, I think, 2022. I mean, that's our own estimates. But at the same time, they still pay like a decent yield of 4% and very strong ROE. But I think there's a bit of timing here. You got to wait for a while. Next slide. Asian Pay TV. So the main highlight for us was the capex dropped a lot. So that's why the cash flows can more than sustain their dividends. In terms of the positives, broadband was a positive. I think almost something like StarHub. Broadband continued to do well. So you can see that the revenue is up 8%, supported by a record number of new broadband subscribers. Capex was the other highlight. So Capex is just to refresh. I think Capex used to be almost 30% of revenue. So every $1 revenue, 30 cents had to go and be spent on Capex. But right now this has collapsed to only 11% in the first half. And because they've already made all these upfront investments earlier. So if you look at the bottom bar, the adjusted free cash flow, you can see that there's a big jump in cash flow, and that's mainly because Capex was down 7 or in the first half was down 10 million. So this is important because they are paying 8 million dividends, 18 million dividends. So 10 million saving is a huge amount. And if you do over 1 year, it could be only 20 million. The negative is the cable TV, which is their core. Cable TV is the difference is that they don't have high content costs. It's not like the cable TV we have here. There's all local channels and the content cost is much lower. But they continue to face circular weakness. I think with OTT, with Netflix and so forth, it will continue to come down, but slowly. I think every quarter, maybe they lose 1-2 million revenue, but some of it will be picked up by broadband. In terms of the outlook, we still think it'll be stable operations. And the group revenue, whatever decline will be kind of offset by the broadband. And any dividends, right now they're paying 0.2 cents quarterly, so they're paying a quarterly dividend of 0.25 cents. Any changes they will decide on the third quarter briefing. So we maintain a buy, still unchanged at 15 cents. We think that the dividend yield used to be 9, I mean, because the share price moved, so now it's about almost 8%. It's backed by 18 million distribution, whereas the cash flow is 82 million. So they're more than enough to cover the dividends. And the balance that they will use it to kind of reduce the debt. And in terms of the next upside will be, of course, we always mention this 5G data backhaul. The timing is unclear. I think it all depends on how fast the mobile operators want to roll it out. But they did reiterate that the opportunity is still there. But there is a timeline because the 5G mobile operators in Taiwan need to roll out their legal requirements to the penetration. So by end of next year, they should need to, I think 70 or 80% penetration, if I'm not mistaken. So this thing will come, but I mean, the timing is just unclear, just to monitor quarter by quarter. And we have not modeled in any of this 5G data backhaul revenue. Next slide. Next one is PropNex. So it was a bumper quarter for them. Next slide. So for PropNex, you can see the PATMI, more than double. The earnings more than double, revenue more than double. So every division did well. I think everything, like rental, you want to see like rental up 100, HDB up 70, everything did well. Agents, private project marketing is new launch, the one is up 160% revenue. So what did well the most is the private resale, which is secondary market. And that's because the industry also jumped quite significantly because you compare it to pandemic levels. And what we're seeing is why everyone is rushing to buy resale is because of the pricing. So the pricing is attractive when you compare against the new launches. So people are rushing for that because new launch can be as much as 40% more expensive. So that's why everyone is going after. And also, of course, there are a bit of lifestyle change, someone bigger units and so forth. And the other positive was the dividend. Interim dividend is up almost 3 times. Whether they can afford it or not, this interim dividend is about 60% payout ratio, which is roughly what they normally pay, 60 to 70, number one. Number two, this payout is about 20 million in the first half, but they generated 30 over million cash, so they more than cover it. And if not enough, I think they still have like 120 million cash in the balance sheet. This is before paying out this, but of course the cash will increase even more because the cash flow is more than dividends. The other attraction positive was the operating leverage. So even though revenue was up 100%, the operating cost, it's not this table, but the operating cost is up only 40%. And most of those that increased were the variable related costs. So in terms of outlook, we think second half would be another strong quarter. I think what we see is it's like a virtuous cycle underway, like a positive momentum underway. So HDB upgraders, they will buy the new units, they upgrade to the new units, and then because the new unit prices rise, then it will kind of stimulate the demand for resale. So there's this kind of virtuous thing happening right now. We downgraded to accumulate because the price just shot, and although we raised our target price quite significantly, we use DCF. So if you look at our report, you see that their valuations is I think about 5 times, 6 times, but do note, transaction volumes is very volatile. So it's not really applicable sometimes to use PE. So we're just using a DCF to kind of value it so that you don't buy this. The lowest PE is probably when the earnings may be kind of peak too. So we don't use PE, so we have to use the DCF to kind of iron out the volatility. But on PE basis, this stock is cheap, right? It's 5 times, 6 times. Yeah. Next slide. Okay, this one's a bit longer. I just wanted to update you what were the commentary they made about the property market, because I think it might kind of interest those who own property, I guess. So in terms of the private new homes, inventory for developers is very low. It's like 4-year low right now because so based on the last 4 quarters, developers have been selling almost 12,000 units, but inventory now is only 19,000. So if they don't replenish, you're almost going to be running out of inventory. So what they think is going to happen is that the developers will be aggressively bidding up government land sales, and you should expect more en bloc projects. So PropNex is also entering into en bloc. They're doing, and this is their new business for them. So they're entering into en bloc brokerage. And right now they have about a pipeline of 6 billion of en blocs identified, which takes time to kind of execute. But according to, they mentioned that they actually had almost 90 en bloc proposals, but they only rounded up to 6 to 7 or something like that. Yeah. Because their strength is they know the market obviously, and they also have good relationship with the developers, so they know which projects can do well, which projects the developers can take the pricing. In terms of resale, of course, that's the hottest now. The 10-year average of resale is about 10,000 roughly. Of course, very volatile. Sometimes some years 14, 5, some years 5. But this year, first half is really 10,000 roughly. So we think that resale could be the highest in the past 10 years. And again, the reason is just that the high price premium of new homes over resale. For HDB is doing well. HDB is going to, because of the minimum occupation period, HDB, after your 5-year MOP, you can sell it. So there's a bumper crop round because there's like, I think 20,000 per year, the next 2-3 years of HDB units that they can now sell. I mean, those under the HDB. So this will be a vibrant market. And of course, what is happening? Who's buying all this HDB? Downsizing. I mean, regretfully, like those in the airline industry, they've seen some downgrade from private to HDB. And there's also this because of the delay in BTO. So people are all they cannot wait. I mean, you're married, right? You cannot wait. So you just have to go and rush to buy the HDB resale. Rental is also surprisingly vibrant. Tenants are shifting to larger units. Foreign demand still resilient because the number of people leaving wasn't that large, or maybe they are stuck here. And also people who are waiting for their new launch or BTO launch after they sold it, right? So they have to kind of temporary housing. Foreign demand is also very strong, but that's confined to the ultra high end, the penthouse and good cars bungalows. And it's not only from China mainly, then Vietnam, Korea. What we see is they even buy here, even if their borders are closed, because they actually buy it virtual viewing can also close a sale. I mean, ask me how, but they have some proxy person here to come help them. Right now, CCR, OCR is very weak. There's a lot of inventory in OCR, CCR. For that to recover, the borders need to reopen to kind of reinvigorate this. I don't know how you call it, lower price, but it's not the ultra high end, I guess the lower high end, I guess. It's like the 2 to 5 million price points. So when the borders reopen, that could help kind of push the market. Yeah, I know, sorry, it's a very long explanation, but just to update everyone, because they are the largest real estate agent. They kind of know the market, I guess. Yeah, next slide. Okay, this is my last part. I'll run quickly for our usual weekly update. Okay, for new homes, we already got the July number, although it's a flash. It's not really from URA, but from because these numbers are out in Lendlease. So for July, the property new launch still very vibrant. It's up 40% year on year for July. So this is a very important number because we all have seen the second quarter results, but this will give us some peek into how third quarter is doing, and it seems to be very strong. Year to date, new launch volume is up 60%. To 8,000 units. And again, new launch also roughly, average, let's say you take 10,000, right? So we are far, far above the average for the last 5 years. The last high, we probably can hit the last high in 2013 when units sold was about 15,000. Other data points we get is a lot of medical data came out. The problem with the medical data comes out every few months, they give a lot of data, then suddenly silent. But there was this number on dental outpatients. So it was up 45% in June. But the only thing is that the 50,000 is still lower than the pre-pandemic. So that's something we need to clarify with the company when they do their briefing or tomorrow. The other thing is the private hospital admissions is down, just for info. Another important one is the ready-mix concrete, which is, I think, more for Jehui because of her Pan United. So ready-mix concrete is right, I don't know, it's up 23 times, but that's an anomaly because there was almost zero during circuit breaker. But even when you compare to pre-pandemic, ready-mix concrete demand is still very strong. But pre-pandemic was 949,000. June was almost a million metric ton. So it's still very strong. So there's still momentum there. In terms of our tactical views on the market, we think our view is that the market might move sideways. I think market is just evaluating this whole resurgence in the Delta virus. I think it's happening, and I'll show you later. There's a big spike now globally and also US, and also some pockets in China. So market's a bit nervous about that. And also the second thing is the tapering decision. The consensus tapering, as in when will the Federal Reserve mention they will not buy any more bonds from the market, in layman terms. The consensus now is probably he will make the announcement in November, December, to announce, and the actual tapering, which is stop buying the bonds they do, is 120 billion they do every month in January of next year. So again, the market also a bit nervous when the Fed will say this. I mean, it's already quite well flagged, but I guess the market is still nervous about that. Yeah. In terms of our PoEMS webinar, we have quite a lot this week. I think we got like 3 this week, MegaChem, OUE. Then the rest, a lot of it will be those stocks that we cover, like Koda, LHN. So this September, we try to get all those that we cover to HRNet, Asian Pay TV. Not all are in PoEMS, but they are confirmed. So if you have time, feel free to register and listen to any of these. Next slide. As usual, we do a track on global pandemic because this will determine the direction of global economies because of the lockdowns. So the blue line, you can see that there's a resurgence now in COVID cases. Hopefully this is not the third wave, but it's not encouraging. I mean, it's rising 40% month on month. You see this big bounce in the US and also in Europe. So this variant seems to be like spreading really, really fast. I need to compare it. Next slide. Okay, in China, the table is on the right. So we wanted to look at the China data. So although it's high, but I think it's only like 100 over cases in China. So it's not such a huge kind of spread in China. I mean, there was up to 600 about a month ago, but right now they seem to have continued well. But Southeast Asia is the problem. You're seeing it in Vietnam, new record in Vietnam, Indonesia, Malaysia, and this is important for us because a lot of manufacturers are in these countries and Thailand too. Next slide. This is my last slide, and I'll just give everyone an update on COVID. So Singapore, the good news is that in the last 10 days, the number of infections has halved. But the thing is that even though we dropped so much, we are back to circuit breaker levels, about 56 cases a day versus circuit breaker 56. I think the good news is that we are almost second dose 75, so a very high chance the reopening will happen because the momentum reopening will happen and the lockdown should be the end, hopefully. Because we're already hitting first dose, so first dose should mean second dose too. I mean, I don't think people take first dose then they stop. So hopefully we can get this whole called herd immunity of 80% by next month, and there should be more reopening, hopefully. I think that's my last slide. So just to quick update for everybody. I think we are open for questions. Thanks.
Perhaps I'll go first, since there's much more question for mine. So just give me a while. All right. So first of all, I just go through the list of counters here because I think due to time limit, I think there are others who want to ask my colleague on other counters and sectors related. So I'll briefly go through like the first one on the list is Capricorn. Capricorn has completed my 5-wave symmetrical triangle, rebounded from the support at $5.10 to $5.17, breakout. You can see that the resistance zone at 548 to 556 has been tested multiple times. Hence, I think that this is a shortfall. And beside that, although moving average of the EMA 63 to 200, exponential moving average is like ranging, but we can see that today this small momentum candle is like a bullish pin bar. It's kind of like well supported at it. And then price is likely if tomorrow or today it end up at a candle with a bullish tone, then we can expect that price will continue to break up further and then target $5.90 to $6 region for Capricorn. All right. So the next one is city development. So city development, I'm still remaining as a downtrend. Major support is still at $6.21 to $6.34, despite there's a bullish divergence. Price rebounded. Believe that $7.12 to $7.21 resistance zone might be a strong selling point going forward. So look out for this. This might be a correction. If it breaks, likely $7.50 will not hold. It'll be like a false breakout, a bull trap, like a salt. All right. So let's move on to venture. Venture successfully has broken out of the double bottom and then a cup and handle kind of formation on this. All right. Price is consolidating at the immediate resistance and support at $19.33 to $19.54. Just now I posted a link to my report, which was released last Friday. It's still valid. So for more information, you may take over there to look at the report. So if $20 fails to hold, Then we are seeing the grand support zone at $17.02 to $17.44 in the mid to longer term run. So to take note of this level at $20 and $17.02 to $17.44. All right, Olam has a severe surprise upside, a bear trap. Price actually penetrate the support term resistance zone at 138 to 142. But if it managed to find a rebound at $1.30, the lowest low of the end, if you use this fig retracement, is at the 88.6, a very ultra deep retracement of the whole swing up move. Okay, so but prices is likely to face some tough resistance at $1.62 to $1.66. So what are my suggestion is, since price has already moved up so much, the death clause is invalidated right now. I would suggest that to wait out on the support over here at $1.50, or light rebound at $1.56 before enter a buy to target at $1.74 to $1.70. China Sunsin, next one. Not much can be said on China Sunsin. Despite a breakout above the falling wedge, price did not sustain above this breakaway gap. Normally breakaway gap signifies that a very strong potential upside, but given the fact that the low momentum and volatility plus one failure swing over here of the RSI, it is likely to push the price slightly lower. I would say is that can look for the support zone at this level at 0.445 to 0.460 moving forward. All right, so this is the battle support that we are looking at. And then if price, another threat that I foresee is that if price is likely to range around here between 0.48 to 0.54 or 55, there is a larger head and shoulder formation going forward, and this likely is going to be a neckline resistance. Okay, so China Sunsin on the longer run, not very potentially higher, unless price actually turned down support and rebounded. Okay. So next one, Mapletree Industrial. Mapletree Industrial, the upside is still ongoing after it has like some correction at $3. I did release a report on this, so you may head to www.stocksdnb.com to read more on it, to get an update, and then to do a confluence of like a report and the current update, which I'm going to share right now. All right, there's back to it. There's a bullish golden cross. Price is there's a consolidation of a flag, like a potential flag. So right now we are currently at a major resistance at $2.92 to $2.96. Price is going to break out a flag, then we can see likely we're going to target at $3.21 in the longer run. All right, Thai Bev is the one that I'm quite happy about it. After I shared, I think a few webinars ago, I think 2 months back or last month, price actually breaks down lower, and then the lack of momentum actually goes down to the support zone at 0.635 to 0.650 before rebound to the upside. Target resistance at 71 and 715. So price is likely to break it. If it's going to break, then we're going to target 780 to 0.88. 0.80 cents. All right, that's what I'll be eyeing. This is a larger bullish flag. If you can look at the weekly chart, then we can look at it. This one is actually near the top of the bullish flag region. Okay. So let's move on to some of the Hong Kong stock that some of you ask. SMIC, it fails to reach my target price at 31.15 to 33.15 resistance zone. Price came down after it breaks off the inside bar, which was on 5th August, which is like a few weeks ago. I think this one was on the Telegram channel. But nonetheless, price actually came down. So this descending triangle support at 21.70 to 23.15. is likely to be broken if there's another way of selling down. So where is the next support? We're looking at 16.75 to 17.75 before rebound to the upside. All right. Costco Ship Holdings, head and shoulder. This is a very classic head and shoulder pattern. Potentially. So this support zone 1 is actually the neckline resistance. Believe that price is going to like form a sell down, retest, and then goes down once more. You can look at 10.56 to 11.38 for a short-term rebound, a scalping kind of rebound, and then support zone 2 is kind of like a longer-term rebound in regards to that for Costco Ship Holdings. Let's move back to the Ascenders REIT. Ascenders REIT, I'm still holding on. Although it hit my first target price at $3.15, based on my report, there's this flag formation like of pattern near the resistance zone 2. I can say that it's going to turn support. You can look at that. Price is actually testing, has been testing multiple times. So price is going likely to break up above. So and then this, you can see that the 63 period moving average is going to, it has crossed slightly above the 200-day moving average. Should the bullish candle emerge victorious tomorrow and Wednesday, then we can see that okay, the EMA is going to have perform a bullish crossover and then cement the bullish upside once again. In fact, I think that the bullish momentum has already come based on the fact that price has already broke out of the downward resistance sloping line of the descending triangle. It's kind of a rare kind of reversal because normally descending triangle are in a very larger type of continuation pattern. All right. Lianpeng Group, Lianpeng, I decided to do on the weekly chart. Discover. Thanks for asking. Discover that there's some opportunity, although there's a gap down today. On that, falling wedge has broken. If you look at that, the 200 weeks and the 63 weeks, which is go back in years, the average has been going up. You can see that resistance has been tested multiple times. And then price rebounded, and then this is likely to be broken. But however, I think that based on the low volatility and volume for Lianpeng Group, we are going to see that this playout is going to prolong into maybe a longer term period. Okay, let's move on to the daily chart. You can see that price actually has is attempting to go up and test. But if you look at the intraday, it says that 50 cents region and 49 cents region is actually a better buy for rebound to break up above the weekly resistance at 0.52 to 0.545. Okay, so there are many who ask about MedTech. In fact, I think across all board, most of the glove companies are experiencing sell down. Not only MedTechs. All right, because of the corrective nature of it, the death cross going forward, I think that I've shared that price is likely to test the support over here. You can see that there's some buying pressure over here, but it's not going to be very strong. In fact, it get down below this resistor support at 0.76. So I think that the downside is going to continue. The gloves are likely to be on a bearish downside once again. You can see that UG Healthcare, which I released a sell call report on things in July. Price has materialized, and then it's going to test the support, lower support at 0.33 to 0.375. Lastly, I think I'm going to share about AEM. AEM, initially I was quite bullish after there's a bullish flag that I shared on my report on that, but price actually failed to clear above the resistance at 420. So hence I think that there's a tendency of going back to the support at 383 before rebounding. Furthermore, I think that what I shared in the report, you can see that the resistance has been tested multiple times. So I'm really I will be glad if there's a price as a bullish support, bullish reversal at a support at $3.81. All right, let's look out further. All right, dark cloud cover was not materialized. So if you look closer, this is actually like A, B, and then we have a elongated wave C before rebound. So these are expanded flat or regular flat of the corrective flat pattern. All right. Nonetheless, I think let's look out for AEM. All right. I think my stop loss level was quite far away because I think that AEM is going to on the upside. And lastly, I think let's look at UMS. UMS also consolidating the tweezer top that I shared that time. So this kind of like consolidation, if the breakout occurs above but rejected at $1.84, then likely there will be a huge sell down back to $1.46 to $1.49. All right. So with that, I'm going to end my presentation. So I'll pass my time back to my colleagues for the rest of Q&A. Thank you.
Hello, I think I'll take the next set of questions. What do you think of Capital taking over SPH? Your advice, is it worth it for them to take over SPH on NAV price? So for us, we see a few benefits for Capital taking over SPH. I think we see three main benefits for the takeover. The first benefit for Capital is that there will be synergistic operational control when they take over SPH, because they are sharing a few assets now. SPH and Capital, some of the assets that they are sharing now are like the Genting Lane and M1. So if Capital take over SPH, then we will likely see then what we'll see is that they can actually synergize this, have synergistic benefits from the takeover, and then they will be able to realize more synergies from that, more like cost synergies when they take over. The second obvious benefit with Capital taking over SPH is there can be, we believe we will see a quick divestment of the PBSA assets that SPH owns. So that is a very big part of SPH's portfolio. So if Capital take over SPH, what they could do is to lease the PBSA portfolio, and when they do that, then they will realize the appreciation, depending obviously on what the valuations did come out. Yeah, and we don't know yet what it is. But the reason why we think that this will likely happen is because SPH actually mentioned divesting this PBSA, which SPH actually, they invested a lot of time and money in the last few years trying to ripen the asset. So now we think the time is right to realize the value of this. So if they can realize the value of this will be equity for Capital. And like what you mentioned, they are taking over at NAV price. So the downside, of course, is difficult to say, but the downside is also quite capped in that sense, unless there's some impairment. Then the last benefit for Capital is the third benefit is when they take over SPH, then there's a chance that they will divest out some of the non-core assets. So if they divest these non-core assets from SPH, some of the property assets that they get from SPH, they will realize the value from this investment. So there's a lot of buyers actually for the different assets. They can find those real estate buyers like ARA Asset Management or some of the overseas buyers to actually take over, sell these assets too. So we think that's the likely route. Capital won't want to manage such a big portfolio, and of course, that's also going to be a boost for their overall AUM. That's a very long answer, but the short answer is definitely going to be worth it for them to take over SPH. It'll be a good deal for them. Yeah. So let me know if I answer your question. I'll go on to the next one. Hello, good morning. Yeah, good morning. Yeah, in recent days, OCBC underperformed the two other local banks. How do you compare the three banks? So if I think when we today we have this slide on the recommendation of the three banks. If you look at, yeah, thanks for putting it to this slide. Yeah, you can see for most of the, for DBS and UOB, we actually upgraded our earnings forecast and also our target price on the two other banks because their results exceeded our expectations. But OCBC, we actually downgraded our earnings because the allowances, I think, was a little bit of a surprise. I think if we had a table on the other slide, we actually the allowances that OCBC made was actually just 9 million GPs in first quarter of 2021. But of course, in the second quarter of 2021, they actually put out GP of 101 million. So we actually thought that the first quarter one was sufficient already, but what OCBC is now saying is it may not even be sufficient, and they project that this may further increase. So the outlook for OCBC is a little bit uncertain. So that's the reason why we think OCBC has underperformed compared to the other two local banks who actually came out a lot more bullish this time round in terms of their outlook for provisions and their outlook for growth. Whereas OCBC is a little bit more uncertain. That's why hence the downgrade. Yeah. Let me just continue to scroll down to see if there's any more questions for me before I hand over to the rest of my colleagues. There's one more question here. Are the Singapore banks a good buy now post dividend? Yeah. So thanks. You can see here in this slide here that my colleagues show here, we believe the banks will continue to see improving ROEs. There are a few reasons why we think the banks continue to be a good buy. Firstly, NIMs have stabilized, so your net interest income will stabilize for this year. So in fact, what the banks are guiding for net interest income is they expect net interest income to see a mid-single digit growth. Then for your net fees and commission, they expect to see about 22% growth for this year. So that's very strong because the wealth management business is really drawing a lot of AUM, so that part will continue to grow. Then the banks are also guiding, at least for DBS and UOB, the banks are also guiding for reversal of GPs. So that will give a further boost to your overall earnings. Then the last thing is their operating their CET1 ratios. Now even DBS is already 70.5%. So we think there's a likely, thanks for moving to this slide. So we think that what the banks will likely do is they will likely have to distribute a special dividend. Again, like what we say, for the benefit of those who maybe join the meeting a little bit later, we think the banks will not declare a special dividend now because it's a little bit too early also, and you tend to send a wrong signal also. But they will likely declare a special dividend to par down this CET1 ratio. Otherwise, if you have such a high CET1 ratio, your ROE gets dragged down a little bit. So if we think that when the operating outlook improves, again, like what Paul mentioned, because the vaccination rates are up already. So if the economic outlook improves, then the banks are likely to declare a one-off special dividend. So that would be the next catalyst for the banks. Yeah. So I think that's all for me. I'll now hand over the time to the rest of my colleagues. Thank you.
Hello, good morning. Maybe I'll take the next question. So there are two questions on Fortress Minerals. First one being any update or comment on Fortress Minerals as its share price has dropped from 68 cents at the time of the report on 16 July to around 51 cents today. And the other one is asking about the counter in general. So a few comments on the counter. Basically, the stock price is very highly dependent on the iron ore prices. If you refer to the iron ore futures, yes, there has been quite a bit of correction over the past week or so. So, and if we look at the reasons for the iron ore prices correction, mainly is due to the trade tensions between China and Australia. So China occupies about 60% of the world iron ore demand, while Australia exports about 40% of the total iron ore exports in the world. So due to the fact that there are ongoing trade tensions between these two countries, China is also trying to reduce the reliance on iron ore imports from Australia. And they also want to reduce the cost to produce the steel, because if the iron ore prices are going to be kept at such sky-high levels, then they are going to incur similarly very high costs for the steel production. So again, a reminder, the iron ore is a primary material in the steel production process. So this situation is also similar to the end May period, when China also announced that they are going to shut down some of their steel mills to restrict the production to combat the environmental impact, the negative environmental impact. And the prices also fell then. It fell to around 180, but currently it's about $160 levels. So this is around the January, February levels in the beginning of this year. But in the long term, of course, we are still going to look at the fundamentals, like how the relationship between the demand and the supply. So demand going forward, of course, your steel production is it is necessary for all countries around the world. You need it for your industrial buildings, your public transports, your everyday devices, and so on and so forth. So fundamentally, the demand is still going to continue to be not say increase, but is sustained. We still expect it to be at such high levels. But on the supply side, of course, China is also trying to increase their iron ore sources around the world. So we will see how the supply is going to catch up to the demand. But the current price corrections could just be a short-term kind of impact. Yeah, that's all that I have for the comments. Thank you for that. Hope that helps. So I'll now pass on the time to the rest of my colleagues for the other questions.
Hi, Paul here. Let me try to answer some. So I'm listening to the. I'm listening to the nanofilm briefing. So sorry, so I was like in between meetings. Let me just run through. The first one is a comment on the recent Singtel price rise. We haven't released the report, but firstly, analyzing Singtel is not easy because they don't really highlight what didn't do well. They only like to highlight what does well. But anyway, so what did well for them was the India turnaround. So you see this big swing for Singtel from loss to profit was because there was a major provision in Airtel last year, because of the extra tax or duties they have to pay. And then now they swing because like almost 900 million right off. So that is no longer there. So that's why you get this big headline swing in profit. But what is driving the underlying profit, that means excluding this, is mainly India. So India kind of almost 100+ million turnaround in profitability. And also the other thing is the strong Australian dollar. So Australian dollar compared to a year ago is up 10%. So these are some of the things that has helped. The curious thing about India is that we value them based on the market price, on the share price, not so much on the profitability on the thing. So it's ultimately Singtel is the Australia and Singapore operations. You value them on the earnings, but when it comes to the associates, most of the market just use the market cap. So we need to kind of relook at the whole valuation before we give a model. So that's why there's a bit of delay in our report. Yeah. Probably it takes us almost 1-2 hours just to go and look at all their numbers, because they also restate numbers. They won't pinpoint what is the real source of the growth. And you end up have to go through line by line. So not like they make it an easy thing for us to go and look at their numbers. Okay, so that's why there's a delay. For nanofilm, the call is actually happening right now, but let me just share whatever I can because I was in between calls. The results did poorly, mainly because of some startup in Shanghai. We don't cover this stock, but I just share whatever I can on the call. They didn't do well because there was some startup in Shanghai. They opened a new factory and they had to as bizarre as we sound, but I knew there was no electricity for this factory, then they had to spend money on diesel. Okay, I'm just saying exactly what they are saying. And also the margins were weak, although revenue is up, margins weak because the smartphones that they do is a bit weaker. The outlook still looks good because the smartphones and new projects, some of the things that they mentioned is a lot of variables business will come in. Third quarter usually the peak, so second half should be better. They also mentioned about the hydrogen project auto that they're working with Temasek, partnering with Temasek. But I don't know how many hydrogen cars are there going to be sold anyway. But anyway, that's one of the things that they're talking about. If you look at the valuations, so if you analyze the first half number, maybe it's a bit unfair. They make like 18 million, then if you analyze it, maybe they make like 40 million. Before the recent sell down, their market cap was 4 billion. So it's like 100 times PE. Okay, maybe it dropped, maybe it's now like 80 times PE. So regardless, I think it still looks quite expensive, despite whatever they've been saying. So, but anyway, that's one of the reasons they dropped. Because when you so the question is, any insights on why Nanofin dropped? The CEO resignation, all that they didn't really address yet because I couldn't hear it so far. But let me check around later. But that's one of the reasons too. Like you mentioned, the CEO also resigned. But I think they didn't really touch much on that. I think all they'll just say is for personal reasons, right? That's one of the reasons. I think the valuation was just very high, and you know you can't afford to make a mistake if you want to have such a like almost 100 times kind of PE. Okay, let me try to answer the next one. Hi Paul, how many % is broadband subscribers expected to grow the next few quarters for Asian pay TV until earnings on 5G come? We think it will still be maybe around 9 to 10% growth for broadband. But the thing is that it will just marginally stand off the basic cable, because basic cable is still the large part. So even if you grow double the size, it may not even even if you grow like you say 10%, which is faster than basic cable, it may not be sufficient to cover the basic cable. So your EBITDA will still decline. The one that you see right here is because of the whole better cost. So revenue will still continue to be weak, maybe 2-3 million a quarter, as you wait for what they call it, the 5G to common stream. But the one that is helping cash flows is the capex. Yeah, that's what is stemming in right now. So I hope it helps. Yeah. So I mean, so for me, the next 2-3 years is still fine until you kind of resolve this basic cable TV, because eventually you need to see some stability. I mean, can't be continue to drop for the next 10 years, right? So for now, the next 2-3 years is still fine, because even though cable TV is dropping 1 to 2 million, the group revenue is still down, but you still have more than sufficient cover from the cash flows. Yeah, I hope that answers it. Okay, let me just quickly run through what's going on with MedTech. Price keeps coming down. Anything serious, fundamental? I think it's just the whole pandemic situation. Just to give you some color, for that, there's also another question on the glove. So what has happened is that glove prices in the third quarter fell 30% quarter on quarter. So there are two things that's worrying the market right now. I think pricing continues to drop. Even though with all this disruption in Malaysia, people thought maybe pricing can hold, but prices still fell. So prices dropped from, I think like it used to be 90, now dropped to 60, 70. And there's a worry it could continue to drop to almost $40 level. And also there's the worries, the second worry is also because of China. So the scenario which Hatta Lega kind of painted was, when the lockdown came, when because Malaysia had MCO, cannot produce, a lot of the suppliers were worried. Then they decided to ask China for supply. Then China said, okay, I can give you, but you must lock in some longer term contracts. So as a result, it gave an opportunity for the Chinese manufacturers to kind of penetrate the market. So that was one scenario. For Riverstone, theirs is a bit more protected because they are into clean room. So almost half the profit, I think roughly, or more than half comes from clean room, which is using their own brand name, and that the pricing tends to be a bit stickier. So everyone will be affected, but I think Riverstone will be a bit less than the others because of the clean room. So the clean room prices are still holding, I think $90 to $100 for now, and clean room glove prices can be more than 2-3 times more than the healthcare. So whenever we mention those spot price like $90 or drop to 60, 70, we are referring to healthcare. And for them, for that, a clean room is still holding about $90, $100. So everyone is affected, but I think Riverstone will be less so relatively. We don't cover them. Okay. Can we just move on to the rest of CapitaLand and REITs monthly? Is Natalie here? No. Okay, I think they're in a meeting. Yeah. Okay. Any views? Yeah. Okay. Yeah, I think she will continue on the. Can Phyllis continue releasing a monthly REIT update like you did end June? Yeah. We will continue to keep up because I think we are in the busy of some deal report. So we could, I think maybe one of the reasons the delay. What is the source of the dental patients medical data? We get it from the MOH, I think. Yeah, we get it from the MOH. But it's very sporadic. The data, some 3 months don't have, then you just data dump after 3 months. Any insights on the recent drop in bauxite? Yeah, we don't really cover. Sorry, I think it will take us some time. What is the long term for Sheng Siong Riverstone? I think Riverstone is we touch. For Sheng Siong, we think Sheng Siong is still good. I think I mean they're still the best grocery operator out there. I don't think anyone has the kind of margins like they do. And they are still coping with the e-commerce. I think e-commerce is loss making, so they don't want to go into e-commerce and kind of lose money. So that's why they are just trading carefully on e-commerce. And China will be the future growth. But just that for the next 6-12 months, I think the earnings will be a bit flat. I mean, the earnings will be down because of last year, but we need to see them reopening stores before the share price might move. I think because without new stores, then people are not comfortable with the near-term growth outlook. No, because Singapore grocery stores, Singapore grocery sales, excluding the pandemic, only usually maybe 1 to 2%. Then you need the new stores to give you that 10% plus growth, additional growth. So without the new stores, people would, I mean, the stock might just move sideways. So that is the that is the one scenario. Why Q&M prices drop and then rise in Friday, drop today? And I really not sure why the date. We will release our report because there's a briefing only tomorrow, so we can only give you more. No, sorry for that. We can only give you more details once the briefing is over, so that we can have a discussion with the management. Yeah. I think the main thing for me, Q&A, is we just want to know how is the patient flow, because like we mentioned in the presentation, the June numbers was a bit softer. But again, we need to talk to them. Maybe it's just seasonal and so forth. Okay, let me just. Will there be a recording of the? Yeah, all our recordings will be on YouTube and also on Stocks BNB. Yeah. Okay. Is there any other things? Your comments on dairy farm, please. Okay, I just listen in. No, dairy farm don't talk to analysts. They just every 6 months they just do a 30-minute call and then good luck to you. But anyway, dairy farm did very badly because of Indonesia. I mean, the malls are closed, so it affected all their groceries. It affected also their IKEA, and also of course Malaysia with what's happening in Malaysia. Because they got a lot of their stores in the malls, so the malls are virtually, totally shut or locked down, or even if it's open, not many people attend. I think that's what they said. What is doing well for them is the 7-Elevens, which is performing relatively better. So for dairy farm, in a very general sense, from my recollection from the briefing, is that it's just the whole pandemic hitting Indonesia and Malaysia, so that is affecting the revenue growth and so forth. Yeah, and also, the year before 2020 was such a good year, right? That's like Sheng Siong. So when you compare to 2021, everything will be down because last year was an exceptionally pantry loading, panic buying phenomenon. Okay. Yeah. So I'm just rushing through. Okay. All these palm oil stocks. My apologies. I think we don't really cover them very well. We don't really have an analyst on palm oil stocks. So. Not very clear, but I think for Vilma, one excitement is the listing of Adani. So that might help lift a bit of the thing. And I think the results was also much better than expected. They managed to navigate the margins well. And you know, I always remember when it comes to Wilmar, a bit of the margins that they get depends on the timing of forward or the timely purchases of forward contracts. So you just imagine if you're doing palm oil, the margin you get if you're lucky refining palm oil could be maybe $10 per metric ton, but the price movement in palm oil can be $50, $60. So even if you don't time your purchases well, you whatever money you make on refining margins might just disappear. So your ability to time, I mean, the word time is up to interpretation. The ability to time when you buy palm oil is very important because you're making so small margin on refining, which is refining means you take the raw crude, you're refining to CPO, the refractorination and so forth. So that margin is so thin. So you need to be able to time it well to get better margins. So that is their strength. I guess their size helps. Yeah, I hope that helps. I mean, we don't really cover, so I can only share as much as we can. I think we more or less run through the rest. I think is all TA. If there are no questions, I think we can kind of can you why union guest? Sorry, we don't really have that. Anything else, Baron? Any other TA you want to do? Otherwise, I think.
I'll just do a last one. I think thanks, Paul. Sorry. I think a lot of people has been asking about Hang Seng Tech. Initially, if you could read my report, I think 2-3 weeks ago, I released one on the Hong Kong. After that, I think it was a mid-Wednesday. Actually, Hong Kong did have a rebound. I mean, stocks like Tencent, Alibaba, JD, Meituan. However, I think if you look at the Hang Seng Tech Index, the Lion OCBC one, the ETF, today there's a huge sell down. So, like I mentioned in the report, unless it clears above the key resistance levels that is being mentioned in my report, so you can head to stocksbnb.com to look for it, or later I'll post it on the chat. The link, all right, so you can download it. Unless back to it, unless it really clears a resistance, then we will say that it's safe that okay, prices are likely to return to the upside. But however, I think there is a chance that Hang Seng Tech altogether, I think the crackdown thing is not going to be over that soon. So the market is a bit jittery. So hence, I think that there will be some slight further sell down going forward. All right. So that's all for my comment. Thank you.
Okay. Just one last one. I think we see it in the chat. It's better if you post it in the Q&A so we don't miss it. But how do you see the current property cycle benefiting APAC Realty? Yeah, it will benefit all the real estate agents. It will especially benefit the larger ones. I think the two agents now, I think they're like 9,000 and maybe ERA. I mean, I'm just recollecting from memory about 7,000. The small, after that, all the small ones are maybe like 2,000, 3,000. So APAC and PropNex really, I wouldn't say dominate, but they have a huge share. So especially what interests us, I mean, 2-3 years ago was whenever there's a new launch of project, right? In the end, these two guys are the one that kind of dominate. I mean, yeah, there will always need be a third and fourth smaller ones, but this is almost like a two-player market when it comes to new launches. The developers will try to allocate, will just rely on these two guys, and the bigger ones get better support, so they can have specialists on certain areas, certain regions, better training, the better IT support. So the big ones really taking larger share from the small ones. I think like PropNex over the last 1 year, they added like 2,000 agents. Excluding ERA, then the third biggest only added like 200 agents. So you can see this, the big ones continue to grow larger and larger and larger and moving away from the small ones. So being large has a lot of benefits. I think the IT support and background and overall support. Yeah. Okay. I think we got to end. I still see quite a bit. I think a lot of it is TA. I'm not sure if it's been answered, but I think we should end it right now. And thanks everyone for your time. We will try to release all the results and brief everyone for all the results. Just that there's too many, everybody released on the same day. So it's a bit too heavy. Yeah. So we will try to brief everyone next in the next briefing. So thank you, everybody. I think we can end it now. Thanks for all your time. And do sign up for our Poems webinar if you have the time. Thank you, everybody. Take care.